Well, Gary, welcome. It's the end of the second quarter investment review and outlook. We haven't met in this forum for a while, so you and I talk regularly, but we didn't share our videos with everybody else yet.
Yeah, well, it's nice to be back on the air again with you. Shelley and I just came back from our first major trip in 2 years. First time to get on an airplane in nearly 2 years. We went up to Washington State to visit Shelley's son, my stepson, and his fiance. And we were up in Port Angeles, Washington, and Seattle. And good to be back home and seeing you again on YouTube.
Yeah, absolutely. This is good. I'm glad people are able to get out there now and start taking trips, and there's a lot happening. Things are opening up.
Oh boy, at the airports and that it sure is. I mean, they were as crowded as they were 2 years ago, and both of our flights to and from Seattle, every single seat was taken.
Wow.
So
and
that's a good thing.
And just think back a year ago, we were on here recording a video, hadn't seen each other in person in a while, and said it could be 3 or 4 years before we get a vaccine and get out of this pandemic. So
yeah,
still work to be done, but things are getting back to normal.
We're on the right path. So I think that's what we can hope for right now.
Sounds good. Well, let's jump into some charts, and we're going to talk about just what's happened so far this year across different areas of the market, and then looking kind of longer term, because we're definitely investing for more than a 6-month time period, and want to kind of see where things are, and then we'll get into a couple specifics and kind of how it relates to the portfolio. So let me share my screen. Okay, I think you can see this is a year-to-date chart, and I'll just quickly run through what the colors are. So we've got a purple for the S&P 500. In my opinion, that's the best index to track on the U.S. economy. It's mostly large cap U.S. stocks. Dow Jones actually isn't that great of a measurement, but a lot of people still quote it. So we've got it thrown on here, and that's in orange. Then we've got the NASDAQ, which is mostly US tech. We've got in green, the Russell 2000. That's going to be your small cap US stocks. Then we've got a few other things out there. So commodities, municipal bonds, and then global real estate, all listed here. So what you're looking at, and we've got a couple more charts, but this one specifically is year to date. What's actually happened in the last 6 months. This is as of yesterday. So jumps out right away. Obviously, we've got a lot of things that are up a lot, and you've got bonds that are barely breaking even for the year, but that's what we would expect in this type of market. What are your observations when you look at this?
Well, I think let's talk about the worst performer, bonds. In this type of an environment, and where the Federal Reserve is holding down the interest rates. And so, if you can get 1.5%, probably 2% in bonds now, you're doing great. Mm-hmm. So it's doing pretty much what I would expect it to do. Otherwise, we're in a bull market. There's no two ways around it. And, it's been good for returns on almost everything except for bonds. So it's nice. We all like this.
That's right. That's right. We're going to talk a little bit later about kind of expectations going forward, but I'll let the cat out of the bag now. We do not expect this to continue at this pace for the long run. No one should expect those type of returns every year, every 6 months for sure. That would be great, but that's not how markets work.
Well, and what I would briefly just add to that is that these types of returns, and we had big returns last year also, a big part of those returns were the expansion of of expected, not just expected, what I would say, price earnings ratios, price to sales ratios, and so on. It's not just about growth of earnings. In fact, the returns that we've seen really greatly exceed the actual increase in earnings that companies are really having. And so you get into times like this of higher price earnings ratios and so on. And there's somewhat more risk in that, because a company that a year ago may have had a price earnings ratio, let's just say, of 20 to 1, and now it's 25 or 28. Can we realistically expect that a year from now it's going to be 35 or 40? It could happen, but I sure wouldn't want to bet on something like that. So we have a higher level of risk at this point.
Right. And I would agree. And just to kind of take that another way, right now, the market is moving not because of what's actually happened from an earnings perspective, but an expectation of these higher earnings and higher growth rates. And that's why you see the valuations go up and all that. And as you said, the risk is there. Okay, what if it's not as good as the most optimistic scenario? Then what happens? What happens when earnings are less and then people are expecting? Um,
Right.
so let's jump to the 3-year chart, just because that gives us a little bit better perspective on this bull market that we're seeing. And you're going to see that we have you see a big drop, obviously, in March, April of last year, or February, March, April of last year. But taking the full 3 years together, and this is total return, things are up. You've had almost a doubling of the NASDAQ tech stocks there. S&P 500 up 67% over the last 3 years. I mean, that's crazy. Think about all that we've been through. That's some great returns.
To say the least. Even look at bonds up 16%. Commodity index, which is at the bottom, but that's still 10%.
Still positive.
This, yeah. And then, of course, the NASDAQ being the best at 98%. I'll take that.
That's right.
And
That's right.
everything in between.
That's right.
I happily will take that. But I think at the same time, um, expectations, I think we shouldn't be expecting that this is going to continue.
Mhm.
Not like this, at least.
Before we move off of the bonds, I do want to mention one thing. So that 16% you see, that's not all um, interest that's been paid out. So there's two parts of bonds, and clients that have worked with us for a long time are aware of this. We talk about how bonds pay returns. You buy a bond, you get a fixed level of interest, but the price also changes. If you were to ever sell that bond early before it matures, you could sell that for a higher or lower price depending on interest rates. So when you have a situation the last decade, last 40 years really, that interest rates in aggregate have fallen, you get two pieces of return. You get interest that's actually paid out, but you also receive some capital gains if you were to sell that, or it's reflected in the price. So that 16% is definitely not interest. Interest rates now, we'd be happy with 2%, tax free. So that's not where all that's coming from. Rates could continue to fall. Europe and most of the developed world really is negative still, and has been for a number of years. We have some of the highest interest rates of the developed world, maybe the highest if you, depending where you put China on that, because China's got higher rates, but at least for equities, they're an emerging market. So just want to mention that on bonds before we kind of move off of that.
Yeah, and I would just quickly add, chart is a great advertisement for rebalancing,
Mm.
because when you saw that huge drop in the early part of last year, Ben was buying some stuff
Mm-hmm.
when it really went down. And Ben continues to do rebalancing, as I think everybody has seen. And, buying stuff when we have a chance to buy it at a cheaper price, and selling off a little bit of stuff that has really shot up in
Mm-hmm.
price. And over time, that tends to increase our rates of return. The old saying that you've had drummed in your head for years by us, buy low, sell high. That's what you have a chance to do some of that, as Ben does his ongoing rebalancing.
Absolutely. Well, and that I pulled up as you were talking there, the 5-year chart now. So this is going from the 3-year to 5-year, and you see just even more pronounced, and how there's not actually always the same winner the whole time. One thing I wanted to point out here is let's just track the S&P 500. So that at the end of 5 years, up 136% almost. But there was a period of time when it was up from that starting point lower than the Russell 2000, lower than the NASDAQ, which is still finished below that. But you can see that at different points in time, these lines will not move all and keep their position in the same spot the whole time. We don't even have in here emerging markets and international, which that would just add more to why we rebalance in a disciplined approach and not how do we feel about it.
Right.
So one thing, just to kind of speak a little bit more to what you mentioned regarding valuations and things at a high and all of those pieces. I'm going to pull up another chart here, and this is looking at those same indices for the last 6 months, but looking at it how much off of a high. So how much off of the peak when you hit the peak are we? And this is as of yesterday. Let's just say everything's close to a peak. So we are, when you're within 2% of all of these indices, I mean, this is why you get the headlines that are really fun to talk about of, the S&P 500 hitting all-time highs and things like that. That's what we're seeing. And so this is just bouncing around. I do definitely want to point out, though, 2 periods of time that's happened so far this year. And again, this is just the last 6 months. So right here, in mid-March, the NASDAQ was down almost 12% from its peak. And I remember the headlines. I remember a couple clients, especially those that are working at some tech companies, reaching out and saying, is this the beginning of the tech bubble burst and things like that? Now, if we had bet that was the case, you would have missed returns from the bottom there, which we didn't bet on that. That's why we take a disciplined approach. But that could happen again. Actually, that will happen again. So whenever you hit highs, unless you continue to hit a new high every day, you're almost always going to be trading lower than the peak. And that's okay. And the other thing I want to mention is I got a lot of calls a couple weeks ago with clients that were reading headlines. And this is what you're seeing here of, oh, the market's been really bad. We're down 1%, we're down 2%. Not that we didn't know about it, but let's just say it didn't register with me that I'd be getting client calls, because down 1% or 2% in a day is just, that's just normal. That just happens sometimes throughout the year. And so it's very valid to call when things are happening, but none of what I see in this chart really surprises me from what you would expect over any 6-month time period on a diversified portfolio. There's going to be parts that are going to be down 10, 15, 20% off of the high most of the time. There will be pieces that underperform everything else. I think maybe it speaks more to the experience we've had since March and April of last year, where things just seem to keep going up, and it's kind of lulled us into this false sense of security on volatility is not here, or at least on the downside. I don't know if you have any thoughts, counterpoints to that, but definitely jumped out to me.
Yeah, and just a quick observation is the stuff that has gone up the most over the last 3 and 5 years, being NASDAQ and the Russell 2000, which is small cap stuff, that's gone up the most, but it's also during bad market times, it's the stuff that's gone down the most. And it's got the most volatility, got the most risk. And so during nice market positive times, we should be able to expect that you're going to have the best returns, and the worst returns during times of, when the market is really gone down. That's another reason for diversification.
That's right. That's right. Okay, so now we're going to shift a little bit, and I'm actually going to pull up something from our risk tolerance software that we use. So we have several different pieces of software that we go into with behind the scenes and occasionally with clients. A few clients have actually seen this work live. Just to kind of prep what you're going to see. So we run the portfolios themselves that we have, all the different correlations and how things move together and why we have diversification. We put all that in and look at long-term averages on how much return you can expect, and then over actual time periods, how much volatility or how much will these move up and down based on historical. And so we come up with this 95% probability. 95% probability, a way to think about that over a 6-month time period, is once every 10 years, you actually expect it to move outside of this over a 6-month time period. So we're going to talk about this, but what I'm actually going to show up is one of the more conservative portfolios that we have. And so this is more in bonds. It's almost 55% in bonds. Got some gold in there, which we'll talk about in a little bit, but it only has 40% in stocks. And so let me kind of just show, like, this is what we're actually modeling on a month to month, day to day basis on how much you should expect this to move. So we put in just a $1.5 million portfolio just to kind of show some real numbers here on what things would actually do. So if you were invested in this type of portfolio, which again is one of our more conservative portfolios, I'm not going to worry about the volatility or how much we're moving away from that initial 1.5 million over a 6-month time period, unless we're getting close to getting outside of this range of down 7.7%, almost 8%. So losing $115,000, or up 13%, making almost 200,000. I'm not going to think anything's wrong, really. It's just working the way it's supposed to if you're in that range. Now, there's other things that are out there. There's other things we track and pay attention to. But if you're just looking at your portfolio and you're seeing the day-to-day movements, you're seeing how much things are moving around, and you're 10% off on the NASDAQ in that example, the whole portfolio added all together will not move in sync with each other. And but this is kind of an expectation. I think for some clients, they hear, I only have 40% in stocks, so I'm not going to lose any money. In the long run, we don't think you're going to lose much and hopefully make money. But it's happened, and this is actually based on historical performance of actual time periods, going back using the actual funds that we have in the portfolio. Do you have any thoughts, Gary? Anything to add, in your experience in going through all sorts of different markets, just kind of as volatility, how to think about the day to day if you're looking at your Schwab statements?
Well, my first thought is simply don't worry about day-to-day changes. It doesn't mean anything.
Right.
We're running a marathon with your portfolios. We're not running, a one-day sprint. And
Or
I
even
think
a 1-year sprint.
yeah, exactly. And I think certainly some people get too caught up in day-to-day, month-to-month changes in the portfolio, because that's just not how we're running it. It's how do we help you get to the goals that you've laid out to us over the time frames that are involved. And we certainly, again, aren't trying to manage for day to day, week to week, month to month returns.
Absolutely. I agree. So let's shift gears a little bit, and let's talk. I know you had some thoughts about gold, and I think they're very timely to kind of talk about what's happened. And so just to help facilitate that, here is the actual fund that we use for clients that we think is the best way to get gold exposure, the Sprott Physical Gold Trust. And this is looking over the last 12 months. So over the last 12 months, we're down 1.5%, 2%. but you can see there's a lot of volatility here at the peak and as far down as you have. So what are your thoughts? What do you see there? What do you want to share?
Yeah, I think the thing there is that, when we originally put gold into the portfolio, I don't know, Ben, 2 years ago, 3 years ago, I don't
Mm,
remember exactly. But the idea of gold was low correlation with the stock market overall. And during the last, year, well, just that has come true in a way we don't like, because the stock market has done so well and gold is treading water. Well, that's what a low correlation means, number one. And it's a part of diversification. But the reason that this doesn't really bother me so much is the fact that over the last 4 to 5 thousand years, gold is something that has maintained purchasing power over that time period for people who have owned gold. I can't think.
just 4 to 5 thousand years. Is that it?
It may be longer than that. That's as far back as I can go, anyway. And I'm not quite that old, so my memory doesn't go quite that far back. But the fact is, over a long time period, gold has maintained the owner's purchasing power. That's a big deal. And a second major reason, that low correlation that I talked about, and gold historically has been a very, very good protector against inflation. And so you add all of those things up, the fact that it's treaded water over the last year, it doesn't bother me at all to
Mm-mm.
have gold as a part of the portfolio. Um, and, if it dropped further, personally, I would add some to my portfolio. And Ben has already added a little bit as it has dropped. But the reasons for having it in our portfolio are every bit as good as they were the day that Ben first bought it.
Mhm.
Even though, in the last year, it hasn't done as good as we would like it to do.
Right. Absolutely. Just want to echo that a little bit. So we've talked to clients about kind of three parts of the portfolio: the growth part, which is primarily the stocks and the long-term, you know, growth of the economy. We've got the deflation protection, which is going to protect if we go the wrong direction and go into a recession or something. And that's primarily bonds are going to be the best hedge in that scenario. And then we've talked a lot about the increasing risk of inflation, and inflation being a very large detriment to the portfolio if it shows up. And more importantly, once prices go up, they tend to stay there. You don't have a huge drop in price again. So once you've reset a floor, similar to what we talk about with lifestyle creep, when you start spending more money and get used to something that costs a little bit more, you tend to stick it there, and it's hard to go back the other direction. Inflation has real world ramifications way more than just the portfolio, and we want to make sure that you've got the purchasing power. And gold is quite possibly the best inflation protector that we have available to us.
I agree.
I'm glad you agree. Thank you, Gary.
Well, so am I. Hopefully, clients are happy about that too.
I think so. I think so. I want to. We've talked about expectations a few times here. Just what's happened in the past year and how client expectations. But I'm going to share my screen to a survey that has been making its rounds on Twitter, actually, and that's where I first saw it, on the financial Twitter. If you want to see a bunch of nerds, just go on FinTwit and have fun there. Gary and I have fun there. But overall, this is looking at, it's a global survey at investors across the world on what do you expect in the future for investment returns. And then they also interviewed advisors. What do you expect? And these are real returns. So the return you receive minus inflation. Inflation matters, but we're just going to talk about real returns here for a second. And on this, we've got overall, the average across the entire world, the average individual investor expects to earn 14.5% a year in the long run for their investment portfolio. And when they surveyed financial professionals, uh, came in at just 5.3%. I don't care as much about what the whole global average is, because we're only working with US investors here, but it's the same. It's 17.5%. It's even higher, individual investors expect, compared to financial professionals at 6.7 above inflation. This gap is huge. Now I hope that our clients are not falling in this gap, but if you are, um, there's never been a long-term time horizon that you've had these kind of returns, even though things have been really great. If you look at those charts that we had for 3 years, 5 years, when we talk about long-term, we're talking decades, not months. And so over the long run, when you average everything out, I just pulled out a few things on what we put into our software. So we are expecting on that very conservative portfolio somewhere in the ballpark of 5 to 6% a year on average, with volatility in between. And that's if you only have 40% in stocks. If you're something more aggressive, 70, 80% stocks, maybe we're at 7.5, 8.5% nominal return, subtract off inflation. And you can see that our returns that we're expecting are a whole lot less than kind of what the individual investors for this survey were. And with that, our financial plan that we put together for our clients pulls into account our expectations. So if we're saying, you can retire at this age and we're planning that you save this amount, you don't need 17.5% return to get there, because we're already building in those numbers that I just pulled in that are a whole lot lower, and I think more reasonable given historical and also looking ahead to the future. Um, I want to add, there's a lot of bias here, recency bias here, because they've tracked this over a period of time, and you can see that as returns have gotten higher over the last decade, so have the expectations going forward. Now, from our perspective, if valuations get higher, as Gary, you mentioned earlier, that the price you're willing to pay for today's earnings goes up, our long-term expectation actually goes the other direction. And we actually expect, if all else is equal, that if prices go up but the fundamentals don't change, you've just earned some returns from the future, not that you're going to get higher returns than after that, because the only way you get higher returns is higher valuations. So with that, there, in our mind, there is somewhat of an inverse correlation to higher returns today compared to the future. And obviously, individual investors, at least according to this survey, have the opposite approach. Anything in your experience that you want to add to this? Have you had clients in the past expect 17% a year?
Probably a few, but fortunately not many. But if you look at that current expectation of 13% above inflation,
Hmm.
I can't imagine something that's much more unrealistic than that, because increases in actual earnings with companies are nowhere close to 13% above inflation. And it makes no sense. And you can't just look at the last, several years and where we've had fabulous returns and just believe that's going to continue. It's just not. Now, when is it going to stop? Well, we're poor predictors, or excuse me, we're poor at trying to project the future. We can't do that, not very well anyway. But we see those types of numbers, and it's just not going to happen.
Absolutely agree. And when you see those types of numbers, there's a lot of people that are maybe borrowing on margin to invest more to try to get those numbers, and that just ramps up the risk, going into things like picking the hot stock that's gone up 200% in the last 6 months. We're going to buy that because it's going to go up again. That's just not how we do things. And we don't think anyone, just like we're not great predictors, we actually don't think anyone is a great predictor that can see the future and say, well, now I know this stock's going to do really well and I need to buy that one and sell this other stock. The evidence suggests that nobody can do that consistently and really, really well, especially over long periods of time. So we don't even try to play that game. We want as many at bats as we can to invest in the global economy and essentially hold everything. And we have tweaks and we have all the different asset classes, and we add things like small cap and value and high profitability and all of those things that matter, that is academically based, that there's rigorous research that goes into it, but it's all about putting you in a position that you can weather through, not we need to get 20% a year return to make the plan work.
I agree. Again,
This is great. You're supposed to disagree with me more often, Gary.
well, I can do that,
Okay.
particularly when we're talking about baseball and
Uh-huh.
things like that.
We're in 2 leagues together and you're losing to me in both. I'm just saying.
Yeah, I know.
Okay.
I'm trying to just, since that's a big change from the way it normally is, I'm just trying to be nice
Sure.
and help you out some this year.
That's right. That's right. Thank you. Thank you for your charity. I appreciate it. So, Gary, I think the next place we want to go is just look at some numbers on debt, on the public debt, and I know you have a few things that you want to share. While I pull up these charts that we talked about, I don't know if you want to just kind of jump into your thoughts, and I'll have some things to share.
Okay. Well, the next chart is about how much debt that we are adding in terms of U.S. government debt. I have really three issues that when I look out over, say, the next 5 years or so, that I think are major issues. Two of them are real concerns. One of them is something that I think is a very positive thing. But if we look at in this chart, we can see what this is over how many, 5 years?
Yeah, it basically goes back to 2012, so almost a decade.
Okay. Well, just the U.S. Treasury outlays that we have, and this is really this is the increase in debt. Unfortunately, I haven't seen this chart before. I'm seeing it right now. But again, this is the increase in Treasury debt outstanding. Is that correct?
Yes. So the top chart is per month. What are the outlays in U.S. dollars of Treasury outlays? The middle chart we have here is the total public debt. You add everything together, and then the bottom chart here is looking ahead 1 year. What is the expectation for government debt growth? How much is that going to change? So we can see a big jump here. That's the pandemic, right there in 2020. And you see that in expectations. You see that in the total amount. I mean, here's the stimulus and everything else that was there. And you can see that in the monthly outlays. But we're still running today at much higher monthly outlays. And you've got the public debt is still obviously all-time highs that we have there. And looking ahead as of today, still expect this to continue to grow at a pretty high clip.
Yes, and as you can see from all of these, the U.S. continues to add at what are, to me, are somewhat alarming increases in public debt. As Ben just said, there are multiple reasons for this, the pandemic certainly being one of them, but we continue to run very large deficits. And those deficits really, from everything I'm seeing, are going to continue to be very large debts, increases in the debt. And in fact, right now, we're increasing debt at a greater amount and percentage increases than we did during World War II, when we were literally fighting for the survival of our country against both Nazism and the Japanese. Now we're doing it at a rate that I'm concerned about, because the Fed is keeping rates very low. When they do that, they are completely flying in the face of one of the major tenets of capitalism. And by that, I mean interest rates with capitalism are designed to go higher when the country is doing very well economically. And what interest rates do is that they make a big part of decision making of companies about whether the rate of return that they're going to get on a projected investment uh, is going to be sufficient to offset the higher cost of borrowing to complete that project, building a new factory, buying equipment for that factory, et cetera, et cetera. Well, unfortunately, the Federal Reserve has corrupted that part. That's a basic part of capitalism, by keeping interest rates super low. And what that has done is that has corrupted the rates of return, and making rates of return to get over the hump of the borrowing, that it is made it that companies, we believe, are doing a very poor job of asset allocation, because they can borrow at such low rates that they now believe that they have all of these investment opportunities that didn't make sense when rates, frankly, weren't where they should be. That's going to have consequences going forward. Now, right now, what companies have done is, even with low interest rates, they are not so much investing in plant and equipment and so on. They're taking the money, putting it into the stock market.
Mhm.
And they can be doing that by buying back their own stock, buying stock of other companies and so on. And that's what is happening with investors, be that pension funds, hedge funds, and so on. And I'm concerned about this level of debt, because when we're borrowing, well, we're borrowing from ourselves, in effect, in that we have domestic investors who are funding this, but also international investors are buying our Treasury debt. And that's a major factor in being able to finance all of the things that we are trying to do domestically. My question is, if we continue to add this much debt to our government balance sheet, at what point might foreign investors lose confidence in investing in and buying government debt? We have a major, major problem, because we are having to borrow more and more from both domestic investors and foreign investors. And I'm concerned at some point foreign investors may very well start to lose confidence in buying US treasuries.
Mhm.
And if and when that happens, and this isn't a prediction, it's a concern, but if that does happen, how are we going to finance the debts, or excuse me, how are we going to finance the spending that is built into the US government budgets? And I don't know how that's going to happen.
Mhm.
but that's a major concern. And it's a concern given the levels that we have in today's stock market that Ben and I just went through here with the higher levels that we are at. And I want to again say this isn't a prediction, but it's a concern. And our job is to keep an eye on the concerns that we have. And if we start to see interest rates really go up and we start to see that particularly foreigners don't want to buy US Treasuries debt, well, at that point, we better be talking to you about it and have plans for any changes that we see at that point in time. But again, this isn't a prediction,
Right.
but we're doing what you're paying us to do is to be aware of this and to be thinking about it between us and what we ought to do in the future. The second,
Before you move
yeah,
on, I'll just add. So clients that think back to some conversations we've had the last 6 months or so, for a lot of clients who went through a 5 economic scenario chart, and that's part of what we talked about. Is we can't predict the future. We don't know what the trigger is or when the trigger would happen, but there are things, just using your scenario, there's 2 very logical conclusions. One's deflation, one's inflation, that you could see happen. And we don't know which direction things are going to go. You've talked about before, Gary, on a previous video, and we've talked about it with clients, a barbell approach to investing to make sure that kind of regardless of the scenario, we're already pretty well allocated. And then we also have room to adjust if we can, if we see something that we can do. And if that time comes that we need to make some changes. And so that's protecting against both deflation and protecting against inflation. We kind of talked about that with gold as well. So I just want to throw that in there. It's not as though we're helpless now and that we just have to wait and just sit afraid of what's going to happen next. But I also wanted to mention it could be deflation, and that's kind of where people go first when you have a lot of debt and you have a default or something, you've got deflation. The other way, and I could see this happening, again, not a prediction, but one answer is you just print enough money to pay off all your bills. If you're the federal government, that leads to rampant inflation, and that's a way to get out of the mess too. Not good for anybody, but that's an option. And there's a lot of nuances there. We're not going to go into that today, but just wanted to mention we've already talked about this. We already have the barbell kind of approach to protect against those dual threats. So I'll let you take over again.
okay. My second major concern, not a prediction, but it's a concern, is our relationship with China. I think we are already in the first or second inning of a Cold War with China. And I think most of you, if you read the papers and watch on TV and the things that are going on in our relationship with China, there's a lot more negative things going on than there are positive things. Now, this Cold War is going to be a lot different than the Cold War with Russia that we got through, because I think the major parts of this Cold War are economic. They're not so much a worry about, an actual war of infantry and tanks and bombing and so on. Although with one exception, I am concerned about that. But the economic ramifications of this Cold War, I think, are really big for us, and they're really big over the entire world. How is this going to work out? I have no idea. And I don't think anybody on the face of this earth really knows today what this relationship is going to be in 5 years. But it is something that Ben and I are watching and tracking because if it continues to get worse, we're going to need to make changes to the portfolio, but it's something that we're really watching. The third thing, and this is a very positive thing, and that is looking at the incredible things that are happening in the technology area. And it's almost across the board. I would say technology, whether it's medical, whether it's communications, whether it's manufacturing, you name it. I am just so encouraged by the kinds of things that I am seeing in the technology area that in 5 years is going to change all of our lives, and I think in a positive way. And I think that's really exciting. And that's happening worldwide. There's a lot of concern about our Cold War with China over technology. And there are certainly areas that China, quite frankly, is beating us. One of those is in communications with the 5G technology. They're ahead of us. There's no doubt about that. But there are many other areas where we're ahead of them.
Mhm.
And that's going to change over time. They'll get ahead of us probably in some other things, and we'll get ahead of them where we're behind now, and so on. But I think overall, this is a tremendous thing for mankind, of the kinds of technologies that I'm reading about and seeing about. I can't think of anything that is great,
Mhm.
going forward. So that's probably the three things that I'm seeing on a big picture basis
Yep,
at this
on a
point.
macro level, for
Right.
sure. And I think your last one is, it's really good not to skip past. It's, we are definitely hardwired, as humans, to think of what could go wrong. I mean, that's part of survival, right? And anticipate those. But when you look at history and you look at human ingenuity and advances, and how it's really hard to conceptualize what exponential growth actually looks like. And as you see everything happening in technology, um, although it's tempting to be pessimistic about the future, I think there's a lot to be optimistic. And just history is probably the biggest reason to be optimistic. You see how much has changed in any period of time with technology and everything else.
Yeah, I completely agree. And what's happened in the last year with the pandemic, the human race has never had any type of a vaccine or pill or anything against any type of a coronavirus. Never in human history. Yet in under 12 months, mostly in the United States, but it's happened in the UK and other places, that we have developed a vaccine against a type of a virus that in human history we haven't been able to touch.
Hmm.
And now we've done it, got it through the processes, and got it approved, and it is saving, I don't know how many millions of lives as the different vaccines saved.
Hmm.
And this was all done in what, 15, 16 months, something
Right.
like that. I mean, that's just, it's so off the charts that that's at least one of the reasons why I think we're really optimistic about when the world puts its mind to doing some good things, we can do it. And it's going
Absolutely.
to happen in the future in a lot of different ways.
Mhm. Great.
That's it.
Well, I think that's a great thing to end on. Any last second thoughts?
I'm working to beat you in both leagues, man.
Okay, okay. Have fun with that. Gary and I are going to go to a baseball game, at least one, still
Yeah,
later this summer, and we've got a lot going on at Illuminate and personally and everything. So we are excited for the future, and we'll continue to have these videos, and hopefully, maybe this fall, this winter, we'll even have another in-person event with clients and things with everyone. Everyone go get your shots, and we can we can all get together
that's
and have a
right.
good time. So
I wholeheartly endorse that. And you and I and our wives all have had our two
we are fully
vaccine shots.
vaccinated. Yep,
You got it.
for sure.
That's why on this call, Ben and I don't need to wear masks.
That's right. Yeah, that's right. Because got to worry about that on the Zoom calls. So
Exactly.
On that note, Gary, thanks for your time. This was great.
It was. I enjoyed it thoroughly.
Sounds good. Take care.